Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to go through a practice problem in OneNote related to a consolidated statement of cash flows using the indirect method. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you have access to OneNote, and you don't need to have access to OneNote, but if you do have access and you want to follow along, we're on the 1028 tab. So in other words, if you go down to the 1028, that is where we are at. We're going to have the information for the problem up top. We're going to go through all the information first, then we'll use components of that information as we work through the practice problem as we do the statement of cash flows. So we have P purchased percent of S on January 1st, 2000 X0 common stock. So P is the parent, S the subsidiary, 75% was purchased. Therefore, the controlling interest will be 75%. Non-controlling interest will be 25%. It was purchased at book value. Therefore, we're not going to have any differential that we'll have to deal with. The fair value of the non-controlling interest is going to be that 25%. The consolidated trial balance at January 1st, 2000 X2 and January 31st, 2000 X2. So in other words, beginning of the year and the end of the year, so we can do our statement of cash flows, will be given. And then the statement of cash flows using the indirect method, that's what we're going to be making from this information. The dividends that were paid out for P, the parent, $35,000, S, subsidiary, $25,000. Here is the trial balance that we will be working with. We have the beginning balance or the January balance of 2000 X2. We will be doing the statement of cash flows as of the end of December 31st, 2000 X2, or for the year ended, December 31st. So you can think about this first one as either, of course, normal kind of process. We're going to have kind of like a worksheet that we will be comparing the prior year to the current year. I'm going to do that with a trial balance format. I think this is a good, useful way to do that. Note that a statement of cash flows, although people have generally a good idea of how to read them, most people still, even in public accounting, don't really understand, I don't think, very well how to put together the statement of cash flows in a very systematic way. So it's a useful skill to know because it can help to put the statement together to understand it, and it also helps you with other accounting kind of things as well, because you're basically deconstructing a lot of times the information. So if you want more information on the statement of cash flows in general, we do have a course on the statement of cash flows that goes over what I think is kind of a more systematic method to help people get through a statement of cash flows if they put one together from scratch in a way that's going to limit the amount of rework or, starting over kind of things that would happen. I'm not going to go through as much detail on that here. Of course, our focus here is to look at the statement of cash flows and simply focus in on those things that are going to be different from a consolidated statement of cash flows and a statement of cash flows, just for a normal statement of cash flows for a business. So normal process would include this for a statement of cash flows. We're going to have the prior year, we're going to have the current year, we're going to be comparing the two, taking basically the difference of the two. We're going to be putting that in a trial balance format. The prior year we could think of as the end of the last year, but we've closed out. So we're looking at basically the balance sheet entries or the post-closing trial balance you can think of. In other words, we have balance sheet accounts up here. We do not have any income accounts, including the revenue and expenses, because they have been closed out, temporary accounts to the retained earnings. And then we have the year that we will, the end of the year, December 2000 X2. This is going to be our information for 2000 X2. We will include the income statement or the temporary accounts here. Here's going to be our net income. Then our first step will typically be to line those two things up and then take the difference between the two. So we'll line up balance sheet to balance sheet, trial balance to trial balance, and this type of format. I like the debit and credit type of formats to do this, and then take the difference. So now we've got the difference being, for example, 1,010,500 minus the 79,500. Difference is going to be the 31,000. There's an increase in cash. Here we've got the 103 minus the 87,000. The difference is 16,000, increase in accounts receivable. Here we have the 125,000 minus the 117,000, 8,000. There's an increase in the inventory, and so on and so forth. If you go down to the liabilities, of course, these are on the credit side of things. So here we have the 15,600 minus the 41,000. This is actually going to be a decrease. It shows us a positive number here, but we're using this debit and credit format. I think this is a useful format to use for our statement of cash flows, and I hopefully that will be apparent as we go through the problem. So then we got our information down here, same kind of process down here. We do need to kind of think about, and we will shortly, the comparison between, the equity section down here. So we'll look at that as we do the statement of cash flows. All right, so our statement of cash flows is going to look like this. Normal statement of cash flows look. We're going to have cash flows from the operating activities, cash flows from the investing activities, and then cash flows from the financing activities. We'll basically fill out this worksheet. So we'll start off with cash flows from operating activities, and since we're using the indirect method, we typically start off with basically net income at that point in time. Now, note that you can think about that as we want to think about these things as differences in basically the balance sheet account. So that's how I would approach that. So the net income you can think about as the major difference between, in essence, the equity section from the prior year to the current year. We do have a bit of a twist that we're going to have here, of course, and that is the fact that this 79,500 represents revenue minus all these expense accounts and the income to the non-controlling interest. But we're not going to be picking up that income to the non-controlling interest. So that's one little kind of twist that we're going to have here, or one of the few. So we're going to say this will basically be the 45025. Let me see if I do that again. 450250 minus the 242000 minus the 45000 minus the 36500 minus the 11000 minus the 1000 minus the 25,000. That's going to be the 89,750, which we can also get to by simply taking the total down here, 79,500 minus the 10,250, and that'll give us that 69. Actually, I should have said plus. Hold on, one more time. It's going to be 79,500 plus the 10,250, and there's the 89,750. So that's going to be our starting point. So notice again, I would also think about this as basically the change in the equity section. So in other words, if you had closed out all of the revenue accounts and had a post-closing trial balance, then that would be closed out to basically the retained earnings and the non-controlling interest. So let's just basically think about that change real quick, and that might help us as we go through and think about how this works out. So let's say we took all of these accounts are the change, right? Because now we've got retained earnings, we've got the non-controlling interest, and then we've got the income accounts that haven't closed out yet to equity. So if we were to take the change in all the blue accounts, then that would be the change in total equity. Basically the change in retained earnings and the non-controlling interest. There's nothing happening to the common stock. So we'll just add up the change in the equity columns over here. So I'm going to say, all right, that's going to be starting with the 35,000 minus the 4,000 minus the 450,250 plus the 242,000 plus the 45,000 plus the 36,500 plus the 11,000 plus the 1,000 plus the 25,000 plus the 1,025,000. This is easier to do in Excel here, but in any case, that's going to be the 48,500. That's basically all the change in the equity. So then we might want to kind of back in and say, okay, what's the difference between that change in equity to the change in equity we basically have up here, which is the net income? What are the things that we're going to have to take into consideration, in essence, to see that change in a balance sheet basically account, the equity section? Well, we know that the income to the non-controlling interest is a factor. So I'm basically reversing that out. If we were to reverse that out, that would be one component. We're basically reconciling down to this 89,750, the 89,750. So then if we had the other thing there's the 35,000 of dividends. So we have the dividends that are going to be included. So we got to take those into consideration. We'll see them later in our statement. And then the total, that's going to be the total of the 89,750. So the 89,750, we've kind of reconciled to what that difference will be. And then we can also see that this 10,250 and the 4,000 is going to be the dividends paid to the non-controlling shareholders of 6,250. So that number will come back later. And so the point here that I want to get to is that this difference you can kind of think of, we want to think of finding the difference within the equity section. Because if we find the difference, if we find a home for all of the differences other than cash, then we'll get to cash, which the change in cash, which is basically our goal here. So this is a component of the total change in equity, and then we'll have to think about these other kind of components too as we go through our statement of cash flows. All right, so now we've got that consolidated net income, in the cash flows from the operating activities. Let's go ahead and continue on with the cash flows from the operating activities. So next thing we typically have is depreciation. And this is another area where most people, I mean, if you go to depreciation, where you would go is the income statement, say there's the depreciation, it's a non-cash item, I have to add that back in, which is true. But note, you also kind of want to think of the depreciation, I would think of the depreciation as a change in the equity accounts. In other words, it's a change in the accumulated depreciation. So here it is here, the 36,500 is the change there, which matches this change down here. So I would think of it as basically pulling it from the balance sheet, the difference in the balance sheet accounts, because you're looking for the differences in the balance sheet accounts, because if you find all the differences in the balance sheet account, that's what's going to get you to the change in the cash up top. Now you might say, well, it's not always the case where the accumulated depreciation is different, is the same. The change in the accumulated depreciation is the same as the depreciation expense. When would it not be? Possibly if you sold or disposed of equipment or something like that, then it would not be. But in that case, I would still think about this number first, putting this number in place here, reconciling, and then going back and finding that actual transaction that resulted in that change. There shouldn't be many of them because sales of equipment aren't going to happen all the time, right? So we should be able to then go back in, find that transaction that took place and make the adjustment. If you make the adjustment as you go, and you do a complex adjustment like that incorrectly, and you do a bunch of them, you're not going to be able to know if it was that adjustment that's wrong or something else is wrong. So what I would suggest doing is putting this number here and then going back in and figuring out any more complexities that are there. This one's going to be a simple item. So then we have the amortization, same thing, intangible assets. We have a difference here. Or we can take it, obviously the amortization is the expense. So we could think of it of the expense, but I'd also want to note, I'd want to see it as the difference in the asset account. Because if I see that, then I know the change is there in a similar fashion with the depreciation. So that's where I would think of pulling it from. And then the changes in the operating assets and liabilities. And when I say that's where I would think of pulling it from, I mean, that's where I would think of pulling it from and then checking to make sure that this number is the same. And if it's not, noting that difference, using this number to be able to reconcile, and then going back and making the change later. And then we have the changes in the operating assets and liabilities still in the cash flows from the operating activities. So we have the accounts receivable. So we have the 103 minus the 87. The difference is that 16. Notice the way the worksheet is set up here, because we're using kind of a debit and credit format and the same difference. We're always going to be taking negative of this number. We will always, in other words, be flipping the sign of the difference column. So every time whatever it is showing over here, we're going to flip the sign. Now you can also spend a good amount of time, and it's useful to do that, to think about why should this be a positive or a negative. If the accounts receivable went up, why should that be going down? And you should probably memorize the general rule and be able to use kind of like a worksheet like this, which will help you with basically a general rule type of worksheet on it. We're not going to spend a lot of time, breaking those things down, but the general rule for the worksheet, and if you want to break those down, we have a course on statement of cash flows. That's statement of cash flow stuff that you can look in that more. But the general rule for the worksheet is just going to be, we're going to take that and flip the sign, and that accounts receivable, when they increase, they will be a decrease to the statement of cash flow, and when they decrease, there'll be an increase. The opposite will be the case for the liability accounts. So then we have the cash in the inventory, same thing. So here's that 8,000. We flipped the sign and pulled it over to the 8,000 negative here. So nothing different here from a consolidated statement to a normal statement. This is a normal process. Then we have the change in the accounts payable. We skipped down and have not included land and the machinery and so on, because those are going to be long-term. Those are going to be non-operating activities. And you could think about that by saying, well, the change in the machinery would be a purchase or a disposal, and there's not really an income statement account effect unless there's a gain or loss on it. Therefore, it's not in typically the operating activities. It would probably be in this case, that would be the financing activities, would be typically where it would go. So then we're jumping down to the accounts payable. We've got the 15.6 minus the 41. So this one has going down by the 25,000. And again, it's kind of like the opposite kind of rules than the asset accounts, but our rule for the worksheet will be the same. We're going to take negative of that number. So it's going to be a decrease or a negative of the 25.4. Then we have the change in the payables, same thing. The payables went up, so it's a little bit different. They went up. And we're going to do the opposite thing too. It's 24.4, so we're going to say negative of that number. 24.4, it's a positive over here. And then the cash flows provided by the operating activities. When you add this up, just make sure that you're adding all the way up to the top. Don't just start at the 16. We're going all the way back up to the top. The consolidated net income, and then everything on down. We're getting to that 102,250. 102,250 cash flows provided by operating activities. Then we're going to go into the cash flows from investing activities. So cash flows from investing activities. Now we have the land. Now we can see that the land went from 45,000 to 55,000, which you would expect then there was a purchase of land of it, so of 10,000. So we're going to assume here, and this is what I would do in practice, that the land was purchased with cash, because that's the easiest thing to do here. Now, obviously, once again, you'd want to do that and then go back into it and see if there are other things involved with that transaction that can complicate the worksheet. But I would even if that's the case, I would first do the one simple change, because that's going to be the easiest thing to do to get back to cash, note it, then go back and adjust it to the more complex transaction that took place that might be affecting more than one area, one at a time, so that you can do it in such a way that you'll always basically remain in balance. And then, so we're going to say the machinery, or the purchase of the machinery here. Once again, we have it going up. So we're going to say there's 35,000 increase in the machinery. So we're going to assume we bought more machinery, and we're going to assume we did so with cash. So we're going to say cash went down by the 35,000. Once again, that's what I would do first off, and then go back in and check and see if that transaction is more complex than that. So then we're going to have the net cash used in the investing activities is going to be the 10 plus the 25 or the 45. Then we're going to have the cash flows from the financing activities. Cash flows from financing activities, we have the change in the notes payable. So notes payable went from 233 to 248, so it went up by the 15,000. We're doing our same thing by saying negative of that number. In other words, we're flipping the sign, so it's going to be 15,000. It looks like that we got more money from the note payable, right? We took on more debt and possibly got more money. That's the assumption that we have here for that. Again, there could be something else going on. I would first put that in place and then say, did we find, maybe that note went up because we financed more equipment that we purchased up top or something like that, that we have to go in and do more complex transaction for. But I would first do this and then go back in and make that adjustment one at a time once we know that we're reconciling to the difference in cash, so that we can then look at the complexities one at a time. Then we're going to go to the dividends paid to the parent company shareholders, 35,000. So the dividends paid were the 35,000 you can see here, and the 35,000 that you can see here. So that's going to be a decrease in cash, of course. And then here's the kind of different thing that's a little bit more complex type of thing, is that now we've got the dividends paid to the non-controlling shareholders. So that's something obviously that would be in the consolidated statement of cash flows that would not be in a normal statement of cash flows. So we're looking at that 25,000, and then we want the percent, which I'm going to go all the way up to the top, which was 25%. So I'm going to say times 0.25. That's going to give us the 6250. So we have the 6250 here, and then that's going to give us the net cash used in financing activities, which is the 15,000, the 35,000 minus the 35,000 minus the 6250. And then, of course, we're going to have the net increase in cash, which is going to be the sum of the operating activities, investing activities, and the financing activities. In other words, the 102,250 minus the 45,000 minus the 26,250, giving us the 31,000. That 31,000 then matching the difference in the cash up top on the trial balance. So then we're going to have the cash at the beginning of the year, which was the 79,500. So there's the 79,500 beginning of the year cash. And then if we add the 31,000 and the 79,500, we get to the 110,500. That's going to be the end of the year cash, which would be on the balance sheet, and of course here on our trial balance. So note that as we go through here, you can kind of see that we basically checked off the changes here, and again, this change is kind of the most a little bit more complex because we did this little table to come up with that change, right? We had this 89 here, and then we also are going to include the 10, 250, and the 4,000, which added up to that 2,650. Notice that was included here. That's one of the kind of differences that we have from the statement of cash flows. And then the dividends, which is included in this, is another item in the change, and that's going to be the 35,000. So, and then of course you could see the change in accounts receivable are going to be the 16. We can see the 8 change here being taken place. We can see the change here, the 10 and the 35 are taking place here and here. And then we can see the depreciation expense, which took place up top. We see the accumulated depreciation took place here. Then the accounts payable change taking place here. And then the wages payable taking place here. The notes payable taking place here. And then all of the equity section, we just basically saw, that's basically this table that we worked out. So we see all those changes taking place, and then again, if you can see all those changes, you should end up then, if you find a home for all those changes, you should end up with a change in cash of the 31,000. And so that's where I would go, and that's where I would go first. And notice we did some simplifications here, or some things could be more complex. I would do more digging. We said do more digging here, do more digging here to see if the transactions are more complex. Do more digging here to see if that transaction is more complex. But if they are more complex, then you want this thing tied out first, and then go do some complex thing in such a way that you can use this as a verification that the complex thing you're thinking about works, because you can think about it in like a transaction type of format, and you should be able to then basically break out, for example, if this machinery change is more complex and it includes maybe a note payable in it or something like that, you should be able to work it out in such a way that these two changes still are represented in the more complex transaction. So that's where I would start, but we're going to keep it here for now because again, our major focus is to look at on those areas that are different, which includes the dividends paid to the non-controlling interest here, how we have to deal with basically the non-controlling interest here and the non-controlling interest in income.